Imagine putting your house on the market today. You look around your neighborhood, and like half of the sellers on your street are in full panic mode.
Oh, yeah, just actively slashing their asking prices week after week.
Right, exactly. But then there's the house directly across the street. The one that, just put a sign in the yard last Thursday.
Mm-hmm.
It just sold in under 6 days.
It's wild.
It really is. Today's briefing reveals a local real estate market that is, well, quite literally tearing itself in two. So welcome to today's deep dive.
Glad to be here.
Today is Wednesday, May 13th, 2026, and we are digging into a massive, hot-off-the-presses daily briefing from Team Price Real Estate covering the Austin area.
And it is a dense one.
Oh, totally.
Yeah.
The mission for you today is to answer a burning question that practically every homeowner or prospective buyer is wrestling with right now.
Yeah, the big one.
Right. In a market absolutely swimming in thousands of contradictory data points, is this currently a buyer's market, a seller's market, or, I don't know, a complete structural anomaly?
It is a brilliant question to frame our analysis around, honestly. Because on the surface, this briefing looks like just a dense packet of raw quantitative data.
Yeah, spreadsheets, market phase matrices, line graphs stretching back 25 years.
Exactly. But the moment you look at the underlying mechanics driving these numbers, it becomes a masterclass in behavioral economics.
Oh, 100%.
I mean, we are looking at real-time psychological warfare between buyers and sellers here.
Okay, let's unpack this, because to understand the battlefield, we first have to look at how these properties are actually behaving out in the wild.
Right.
And the data establishes a massive paradox right out of the gate. Currently, there are 16,410 active residential listings on the market.
Which is a solid amount of inventory.
It is, and that total inventory is down just a hair, like exactly 1.01% from this exact time last year in 2025.
Okay, so pretty flat year over year.
Yeah, pretty flat. But here's the jaw-dropping metric. Almost half the market, 49.8% of all active listings, to be exact, has had at least one price drop. Yeah, half the market is actively bleeding equity to find a buyer.
Which normally functions as a glaring indicator of a distressed market.
Right.
When 50% of the inventory is cutting prices, the traditional assumption is that, well, demand is completely evaporated and sellers are just capitulating.
I have to push back on that traditional assumption immediately, though.
Go for it.
If demand has evaporated, how do we explain the other half of the briefing? The data also shows that 29.8% of active listings hit the market in just the last 30 days.
Mm-hmm.
And for the homes that actually go pending, the median time it takes from the moment the listing goes live to the moment a contract is signed is a blisteringly fast 6 days.
6 days.
6 days. Honestly, are we sure this metric isn't just like a statistical illusion?
What do you mean?
Like, could we just be seeing institutional cash buyers swooping in on those severe discounts, absorbing the desperate sellers, and making the timeline look artificially fast?
What's fascinating here is that the data explicitly refutes the idea of a purely institutional bailout.
Yep.
Yeah. Pending listings are actually up 2.5% year over year. There are 5,180 homes actively under contract right now.
Okay, so the volume is there.
Exactly. The buyers are absolutely out there, and they are highly active retail buyers. The mechanism creating this paradox isn't a lack of demand.
What is it then?
It's hyperselectivity driven by algorithm fatigue.
Oh, algorithm fatigue. I like that term.
Yeah, I mean, buyers have been battered by a volatile macroeconomic climate over the last few years. They are intensely protective of their capital right now.
Makes sense.
So when they enter the market, they are instantly filtering for properties that are fresh, pristine, and priced in strict alignment with today's mortgage realities.
So that makes the days on market metric act like a poison pill.
Precisely.
If the median time to contract is 6 days, that means if your home doesn't secure a buyer by the end of its very first weekend, you are instantly categorized as stale inventory.
Precisely the mechanic at play. The modern buyer assumes that if a property sits for even, 3 weeks, it is either structurally flawed or the seller is harboring delusional pricing expectations.
So they just skip it.
Buyers simply bypass the stale inventory altogether. They don't even bother negotiating with a stubborn seller.
Right. Why bother?
Exactly. They just wait for the next push notification on their phone and buy the brand new listing down the street that was priced correctly from day one.
Wow.
That is exactly how you get 50% of the market languishing on a clearance rack while the new arrivals are vanishing in under a week.
That analogy is perfect. It's like a trendy boutique with a massive clearance rack in the back.
Yep.
So if the buyer is locked in a cage match over fresh inventory in certain scenarios, how do we explain the geographic extremes?
Because they are extreme.
Here's where it gets really interesting, because the briefing proves we cannot talk about Austin as a single monolithic market.
Not at all.
Buying real estate in Central Texas right now is acting exactly like picking individual stocks.
Oh, 100%.
The activity index in the briefing, which measures localized demand versus supply, pegs the overall market average at 24%.
Right, which they define as the softening phase.
Yeah, softening phase, slower sales, rising inventory. But you look at the city of Round Rock, and it is booming with an index of 30.1%.
Officially placing it in the expansion phase.
Exactly. Strong localized demand.
Constrained supply, creating isolated seller leverage.
But then you drive 20 minutes down the highway to Manchaca, and a staggering 71.4% of the listings there are seeing a price drop.
Which is just wild to think about.
Nearly 3/4 of the entire local market is actively slashing prices. Geography doesn't just change the commute right now, it changes the underlying math of the entire transaction.
It really does.
Why are adjacent areas behaving like entirely different planets?
We have to look at the catalysts driving localized demand.
Okay.
Round Rock, for instance, isn't just a bedroom community anymore. It has mature economic anchors, specific corporate relocations, and, established infrastructure.
Right, it draws people in.
Yeah, that sustains an influx of high-earning professionals regardless of broader macro trends.
And Manchaca.
Manchaca, conversely, might be dealing with a localized glut of new construction. Homes that hit the market at the exact moment, interest rates priced out their specific target demographic.
Oh, bad timing.
Exactly. The broader demand didn't vanish, it simply concentrated in areas with higher perceived resilience.
That concentration effect becomes honestly terrifying when we look at the metric for months of inventory.
Oh, the inventory numbers are brutal.
For anyone unfamiliar, that metric basically measures how long it would take to sell everything currently on the market if no new homes were listed.
Right.
The overall MLS has 5.96 months of inventory. Austin proper is at 4.95 months, which the matrix classifies as maintaining a slight seller edge.
Just slight, yeah.
But look at the exurbs. Dale, Texas is sitting at a staggering 35.25 months of inventory.
35 months. That completely redefines the concept of a stagnant market.
That is almost 3 full years of supply. I mean, if you put a sign in your yard in Dale today, mathematically, you might be waiting until 2029 to close.
Yeah, it's pretty grim.
How does an exurb experience such a massive inventory shock compared to the urban center?
This is the breakdown of the drive until you qualify dynamic.
Okay, what's that?
During periods of artificial affordability, when rates were near zero, buyers pushed further and further out into exurbs like Dale to maximize square footage.
Right, because money was cheap.
Exactly. The commute was justifiable, or remote work made it totally irrelevant. But as rates normalized and return to office mandates solidified, the buyer pool for a home 45 minutes outside the urban core completely evaporated.
It's gone.
Completely gone. The months of inventory matrix in the briefing is a brutal arbiter of this reality. Anything under 4 months is seller acceleration.
Okay.
Anything over 9 months is buyer control. Dale isn't just in buyer control, it is an absolute buyer's monopoly.
Because these have so many options.
Right. And the physical immobility of real estate means a house in Dale cannot be relocated to satisfy the intense demand in Round Rock.
That is a great point. The geographic isolation is clear, but the briefing shows the leverage shift isn't just about where the house is located, right? It is heavily dictated by the price tag itself.
Oh, the price tiers are a whole different story.
The squeeze on the different price brackets is fascinating. Look at the $200,000 to $300,000 range. 55.31% of active listings have price cuts.
Over half.
Yeah, with the median cut sitting at over $16,000.
We really need to contextualize what a $16,000 cut means for an entry-level property.
Yeah, it's huge.
It is not just a rounding error, it is a fundamental shift in the buyer's debt-to-income ratio.
That is the exact friction point. For a buyer stretching to afford a $250,000 home, the prevailing interest rate dictates their entire reality.
Every single dollar matters.
Right. A $16,000 drop in the principal is often the literal difference between the bank approving the loan or rejecting it. They are hypersensitive to the monthly payment.
Exactly.
But then you jump to the luxury tier, the 2 million plus homes. The sellers up there are slashing a median of $250,000 off their asking prices.
$250,000 wiped out.
Just gone. Those buyers aren't sweating a minor shift in the 30-year fixed rate?
No, not at all. You are identifying the difference between rate sensitivity and liquidity constraints.
Okay, unpack that for me.
The $200,000 buyer is entirely dependent on the cost of debt. The $2 million buyer is dependent on capital allocation. The luxury market currently sits at 12.71 months of inventory, so deep into buyer control.
Right, because it's over 9 months.
High net worth individuals are looking at alternative investment yields, stock market volatility, and capital preservation. They are entirely willing to walk away unless the seller capitulates.
Because they don't have to buy.
Exactly. If you have $2 million in purchasing power right now, you are demanding a $250,000 discount just to compensate for the opportunity cost of tying up that capital in a physical asset. The $400,000 buyer in Austin proper is fighting a totally different war with zero leverage compared to the luxury buyer in the suburbs.
So what does this all mean for the psychology of the market at large? I mean, having established this incredibly fractured landscape of micromarkets, we had to zoom out and address the historical elephant in the room.
We do.
Why are 50% of sellers across the board getting their initial pricing so devastatingly wrong?
It's simple, really. They are pricing their assets based on an obsolete paradigm. They are anchoring to an anomaly.
Let's look at the actual numbers of that anomaly. The median sold price for May 2026 is $460,000.
Okay.
Taken in a vacuum, that metric looks incredibly healthy. It is up 6.6% from just last month and up 3.8% from a year ago.
Which is great.
It looks like a market experiencing steady positive appreciation.
It's a textbook definition of a stabilizing asset class on a 12-month trailing basis.
Except that $460,000 figure is still down a painful 16.36% from the absolute peak of the market.
Yep, there's the context.
The peak occurred exactly 4 years ago, in May 2022, when the median price was an astronomical $550,000.
Wild times.
We are talking about a $90,000 drop from the high water mark.
The behavioral economics term for this is the endowment effect combined with anchoring.
Okay, anchoring.
Yeah. A seller in May 2026 isn't looking at the 3.8% year-over-year gain. They are exclusively focused on the fact that their neighbor, with the exact same floor plan, sold for $550,000 4 years ago.
They want that same payday.
Exactly. They have psychologically endowed their own property with that peak value, completely ignoring the macroeconomic forces that created it in the first place.
The briefing does a wild projection regarding that peak. It utilizes Austin's 25-year compound appreciation rate, which is a very steady, historically proven 4.873%. Based on that baseline, it projects that it will take 47 months, pushing us all the way to March 2030, just to get the median price back to that $550,000 peak from May 2022.
That is a long road.
Think about your own neighborhood right now. Think about the psychological journey of a listener who bought a home at that absolute peak. They paid top dollar, waived their appraisal contingency, fought off a dozen other offers.
Probably skip the inspection, too.
Oh, probably. And now, 4 years later, the data suggests it will take another 4 years, an 8-year total cycle, just to break even on their principal. Is the market structurally broken, or did the collective consciousness just lose its grip on reality in 2022?
If we connect this to the bigger picture, it becomes evident that the market is not broken today. Today's market is actually the cure.
The cure? Really?
Yes. We have to visualize the 2021-2022 market not as a baseline, but as a heavily compressed spring.
Okay, I can picture that.
You had a black swan event that drove interest rates artificially to the floor, combined with massive demographic migrations, creating an extreme, unnatural compression.
Right.
When that spring released, it shot prices to that $550,000 peak, completely detaching from the 25-year 4.8% historical trend line.
So it was just a violent upward release that defied basic economic gravity.
Exactly the right framing. But gravity always reasserts itself.
It always does.
The source material provides critical historical context here, too. It tracks a previous cycle in the Austin market that exhibited a 40-month drawdown followed by a 76-month recovery.
Wow. Okay. So this has happened before.
Yes. We are currently experiencing the stabilization phase of a very familiar historical pattern. Real estate is fundamentally designed as a long-duration utility meant to compound slowly over decades.
Right. Not overnight.
Exactly. The zero interest rate environment tricked an entire generation of buyers and sellers into treating residential housing like a speculative tech stock.
Which introduces a huge cognitive dissonance for anyone trying to time their entry or exit right now.
Oh, absolutely.
When a seller lists their house today, they price it at $550,000 because they feel entitled to the peak.
Yep.
The buyer, looking at a 7% mortgage rate, looks at the same house and says, well, the math only works at $460,000.
And neither wants to blink.
Right. The seller refuses to concede, the house sits for 45 days, the algorithm flags it as stale, and suddenly the seller is forced to join the 49.8% of the market, slashing prices just to get a showing.
The sellers who understand the compressed spring analogy are the ones succeeding right now.
Because they price it right.
Yes. They price aggressively at today's $460,000 reality, capture the hyper-selective buyer pool immediately, and secure a pending contract in 6 days.
Just boom, done.
Done. The data illustrates a ruthless efficiency. The market rewards sellers who operate on current math and severely punishes those who operate on historical emotion.
So to wrap up this journey for you, the listener, if you are evaluating the Austin market in May 2026, you must completely discard the idea of a unified housing market.
It just doesn't exist anymore?
No, it doesn't. You are dealing with hyper-localized microclimates. Overall inventory is hovering around 16,400, but its behavior is entirely dictated by zip code and price tier. If a home is fresh, pristine, and priced for today's interest rates, it is vanishing in an astonishing 6 days. But half the market is stubbornly lagging behind, trapped in their own behavioral biases, slashing prices to eventually adjust to a post-2022 reality.
Yeah.
It's a landscape where a house in Round Rock sparks a bidding war, while a house in Dale might sit unsold for 35 months.
This raises an important question, though, and it is the critical takeaway for anyone managing their own assets.
What's that?
When we evaluate our own local housing markets, our own net worth, or our own financial leverage, how much of our perception is grounded in actual verifiable data from today?
It's a great point.
Right. And how much is anchored to the psychological ghost of what the house down the street sold for at the absolute zenith 4 years ago?
Yeah.
Are we making pragmatic decisions for 2026, or are we letting the ghosts of 2022 hold our equity hostage?
That is an incredibly powerful framework to analyze our own financial biases. Well, thank you so much for joining us on this deep dive.
Thanks for having me.
The raw data might seem dense at first glance, but the human psychology and behavioral economics hiding just beneath the surface are, well, they're endlessly fascinating. We warmly invite you to bring more of your sources, your questions, and your curiosity to the next one. We'll see you then.